Hi, I'm Grant Stephen.
And I'm Chris Bernier.
And we're the two investment guys. This week, Chris and I want to talk a little bit about some of the market dynamics. But firstly, if we look at the index returns from around the world, we see that Toronto is up about 3% so far this year, where the Dow is up 9% this year. When we look at Europe, we've got London up 9%, France is up 5%, and Germany's up 4% so far this year. And then the major Asian markets, Hong Kong's up about 2%, while Tokyo is up a whopping 18% so far this year. Chris, those are clearly mixed results. We wanted to talk a little bit about some of the drivers behind capital market behavior so far this year.
Well, one of the things that we've seen, particularly over the last several months, is a shift in some of the headline news. So we were dominated on a lot of the negative stuff going on in Europe and China and so on, and it's shifted to be more positive, and the focus has been on the positive for some time. Every time we get a little piece of negative news out, the market kind of shrugs it off and has tended to move higher. We've also gone through earnings season here, and by and large, the earnings reporting was pretty good out of the S&P 500.
Yeah, it was overall. Chris, you and I have talked about the jobs report and how important all of that data is to capital markets. Well, an example was the most recent U.S. jobs report on the February numbers, where the new jobs was 236,000, where the estimate was 165,000 for the month. So that's a big beat in our side of the world. And even in Canada was up about 50,000 jobs for the month, and looking for about 35,000 on the estimate. So we've always said that watch the jobs number. That's a really important piece of the puzzle. Now, one data point isn't a trend, but clearly the trend has been higher.
Yeah, absolutely. If we compare Canada to the U.S., it's 2 years consecutive now that the U.S. equity markets have outperformed Canada. And the primary reason for that is what's going on in China. We've seen a slowdown in China, some of the activity in terms of building infrastructure and so on. And although things have improved since the end of summer last year, some of the jury is still out, I guess you could say, in terms of some of the data that we're seeing out of China, which continues to be somewhat mixed.
Yeah, and that's an important piece of the puzzle for Canada. But even when we look at Europe, Chris, we see slightly weakened data there. When we look at the Toronto Stock Exchange, what we have is on their earnings side, the energy numbers were down about 30%. These are earning numbers year over year, and materials were down 12%. Well, that's 50% of our stock market. So we're telling people, you need to be looking elsewhere and following that diversification. Last year, Germany was the big global producer and or return number on their capital markets, and this year so far it's a little early, but Hong Kong, and who would have guessed those? So that's the diversification story.
That's right. When you look at Tokyo, the Bank of Japan, all the stimulus that's coming into the market, nobody can predict that. So the name of the game is really diversification.
Right.
I want to thank you again for your questions and comments. Please keep them coming. You can contact Grant and I at twoinvestmentguys.com.
Join us next time. We're going to continue our discussion about markets. So until then, I'm Grant.
And I'm Chris.
And we're the two investment guys.